ladies and gentlemen. Thank you very much. It's good to be here to talk about yellowcake and to talk about the outlook for the uranium market, which is really what our company has been set up to follow. Just quickly, yellowcake IPO'd in 2018, and the thesis was then that the supply-demand fundamentals for uranium were such that we thought the uranium price needed to go up or had to go up. And so we created this company or entity which allows investors to express their opinion in the uranium commodity by buying our shares. We have a long-term buy and hold strategy. We don't trade uranium. We buy it and hold it for the long term. We have a 10-year framework agreement with Kazatomprom, which is the world's largest and lowest cost producer of uranium. And this allows us to buy up to $100 million of uranium per annum, essentially at the spot price. So, the spot market for uranium is very thin and not very liquid. So having the ability to buy up to $100 million, essentially at the spot price, is a very, very valuable strategic advantage that we have. The option is an annual option, so it's completely at our discretion. It runs 1 January to 31 December. We can do all of it or none of it in multiple tranches. So it gives us a lot of flexibility. Our inventory is stored in 2 locations, one in Canada and one in France. There are only 3 places in the West where you can store uranium, one in the US, one in Canada, and one in France. We store most of our uranium in Canada and some in France. We have a low-cost outsourced operating model. We only have 2 employees, myself and the CFO. We both work from home. We don't have an office. And we've outsourced our IT and accounting and uranium transactional services to third parties. So we target an operating cost base of less than 1% of net asset value. If I turn to our balance sheet, we own around 20 million pounds of uranium, and if you take the spot price today of $54 a pound, it's over $1 billion of asset value that we are sitting on. We've got a little bit of cash, but that's essentially our balance sheet. There are no funding structures, there are no hedges. Our inventory is all equity financed, and the way we operate is if we trade at a premium to net asset value, we'll issue equity and buy uranium. If we trade at a discount, we won't, because that's dilutive to existing shareholders. In the rest of the presentation, I'm going to cover the factors that drive the uranium market. I recently sat on a panel with the CFO of Cameco, which is the world's second largest producer of uranium, and he said the decade that's just passed is the sort of decade of demand uncertainty for the uranium market, if you look at post the financial crisis and post the Fukushima event. He said that the decade ahead of us is the decade of supply uncertainty, and I completely agree with that, and I'll talk about why. We've got a number of factors coming together driving the demand side, and all positively. Climate change, energy transition, we've got reactor build programs, we've got life extensions for existing reactors and small modular reactors. Energy security and energy independence are important themes now. And the long-term contracting by utilities that consume uranium is starting to increase. So those demand factors are driving a positive outlook on the demand side. But against that backdrop, we've got a supply side that's been challenged. And I'll go through those points in a bit more detail. Climate change and energy transition is increasing the focus on nuclear and nuclear energy. I think nuclear is now being seen as a contributing technology to a decarbonizing world. It's an essential element, and the nuclear energy or nuclear reactors run at very, very high capacity factors. So a nuclear plant would run at about a 92%, 93% capacity factor compared to wind and solar. Wind's around 35% and solar is 25%. And we know the wind doesn't always blow and the sun doesn't always shine. So nuclear is a very reliable, predictable energy source that can run 24/7. Uranium is primarily used in the electricity sector to fuel nuclear reactors. And if you look at the forecasts, there are forecasts that say that the world need for energy will double between 2020 and 2050. And, greenhouse gases from the energy sector, about 25% come from electricity generation. And that's, today it's principally coal. So we are going to need nuclear in the energy mix going forward if we want to meet the 2050 climate goals that have been set. The International Energy Agency is forecasting in their zero emissions scenario that nuclear will double, or the need for nuclear will need to double between now and 2050. Just looking at the demand side, there are currently 438 reactors that operate in 32 countries around the world. This produces about 10% of the electricity for those countries. There are about 162 reactors that are under construction or planned. 53% of those reactors are currently being built or planned, or 53% of those being built are being built in China, India, and Russia. And 80% of the reactors being planned are in those three countries. But we're also seeing, nuclear growth in other emerging economies. Turkey, Egypt, the UAE have just commissioned 4 reactors. So the nuclear demand side and growth side is looking better. But if we look at the existing nuclear fleet, the US has the largest nuclear fleet of about 92 reactors. And if you include Western Europe, it's about the same size as the US. So about 75% of the existing reactor fleets are in those Western countries. And, the conventional wisdom a few years back was that those fleets would decline. They would age and decline. But we're seeing a lot of emphasis now by governments across the world to protect those valuable assets. If you look at the Inflation Reduction Act in the US that was recently passed, and total up all the commitments in that act, something like $40 billion have been set aside to protect existing nuclear and to facilitate new nuclear. The other exciting development in the nuclear space is small modular reactors. These are reactors typically less than 300 megawatts. If you look at a big reactor, it's about a gigawatt. They are easier to construct. They are simpler, cheaper, and you can build them in a factory and assemble them on site. They are also able, nuclear is a perfect heat source for desalination, district heating, and green hydrogen. So these small modular reactors provide the flexibility that when the wind doesn't blow or the sun doesn't shine, they can all generate electricity. But if that's not needed, they can be switched to heat, hydrogen, or desalination. Also, they take up very, very small footprints, so you can site them on existing permitted sites, be they nuclear sites or what we're seeing in the US. The US government has identified something like 152 sites where they're coal-fired power stations that are coming to the end of their lives. Those sites have got grid connectivity. They've got workforces who know how to run boilers and heat systems. So, it's the perfect location for these small footprint reactors. Let me touch quickly on Russia's role in this industry. Russia produces about 5 to 8% of the world's uranium. But in the nuclear fuel cycle, which is in the conversion and enrichment phases, Russia accounts for about 35% of global conversion and almost 50% of global enrichment. So if you look at the fuel that flows today into the US and into Europe, you look at the average over the last 5 or so years, about 23% of the US's enriched fuel comes from Russia, and in Europe, it's 30%. So, Russia is a big player in that sector, and the Russian invasion has really, turned that sector on its head as utilities have sought to find other sources of enriched fuel. What are we seeing? I think the Russian invasion of the Ukraine highlighted the West's dependency on Russian fuel. Sanctions have to date not been applied to nuclear fuel, so nuclear fuel still flows from Russia to the US and from Russia into Europe. But we are seeing that utilities are sort of starting to self-sanction. They're seeking out other suppliers of that fuel, although it's not easy because of the Russian domination. But we're going to see a deglobalization of the fuel market. Earlier I said that about 75% of the nuclear demand really sits in the West and Japan. And I think going forward, that 75% will be serviced by Western-facing suppliers. It will take time. It takes 3 to 5 years to build the necessary capacity, but I think it will happen. And going forward, Russia will really look to supply China, India, Pakistan, some countries in the Middle East, and in South America. But today, the biggest demand still sits in the West and Japan. So, Russian fuel hasn't been sanctioned yet, but there's a growing sense that it may be sanctioned. In the US, very recently, the Reduce Russian Uranium Imports Act is seeking to exclude Russian fuel from the US. That hasn't been passed into law yet, and it also contains some waivers to allow utilities that are dependent on Russian fuel to still procure fuel. Similarly, in Europe, we've seen the European Parliament propose the bill to sanction Russian fuel. Again, that hasn't passed because Hungary objected. They're a big user of Russian fuel. But it's, whilst these sanctions haven't happened, there's a sense that they may happen. And then it's going to be very, very interesting to see how the nuclear industry responds. And just briefly, what the US did recently, back end of last year, they went out to market to buy 1.1 million pounds of uranium from US producers, and they were prepared to pay 30% above the spot price at the time to secure that inventory to build up a Federal Reserve of nuclear fuel. This industry runs on long-term contracts. So, your utilities like EDF, Exelon, Duke, they buy about 85% of their fuel under long-term contracts. So these contracts are typically 5 years plus. They can run out to 8 years. Since Fukushima, we've seen a decade of under-contracting. And by that I mean that the contracts that are renewed every year have been about half of what is being consumed. Globally, reactors consume about 170 million pounds per annum, and we've been contracting at way below that level, which means that inventories have been drawn down. Since the unrest in Kazakhstan and the Russian invasion, we've seen a turnaround in contracting. Last year, for the first time, we saw contracting at above 100 million pounds. Year to date, we've already seen 100 million pounds, and we're only into May. So we're getting into the phase where we think there's going to be contracting at least replacement level for some time. Now, I've spoken about the demand side, and against that sort of positive demand scenario, the supply side doesn't look very good. If you look at most commodities, take copper for instance, you talk about demand and you look at China. In uranium, the demand looks bright, and it takes 10 years to build a reactor, so the demand's very visible. The supply side is where I think the problem is going to lie. We've seen a decade of underinvestment in new mines and exploration, and now, we're at a point where we are producing below consumption rate. So, with COVID, it was the biggest or the lowest production rate in the past decade. Was 126 million pounds were produced against 175 million pounds consumed. And we've seen some restarts, but we're going to need new capacity, big new mines to come on stream. And it takes 10 years from exploration to building a mine to having the product. So, and we're also at a time now where we're seeing CapEx inflation, 20, 35% inflation on CapEx for new projects. We're seeing skill shortages. So I think this is going to be about the supply side. And if you look at that chart, there's that green section which talks about, probable projects. And we know in the mining industry, the industry is not very good at bringing projects on time and on budget. So, I think this is going to be a supply-constrained industry, at least in the midterm. So, in conclusion, I think I spoke about the demand side story of energy transition, decarbonization. We're seeing reactor builds. We're seeing life extensions on existing reactors, small modular reactors. We're seeing energy independence and energy security becoming a major theme. And we're starting to see utilities contracting again. And again, against that backdrop, we are seeing a supply-constrained world. And with that, we think Yellowcake is very, very well positioned against that supply-demand backdrop. And with our contract with Kazatomprom, we have the opportunity to grow significantly into the future. Thank you.
Terrific. Thank you very much indeed, Andre. So if you have a question, please raise your hand and my colleague will come over with the microphone. Thank you.
Okay, sure. Oh, thanks for the talk, Andre. I understand that the discount to net asset value is currently about 15%, which is understandable given the sort of sentiment in the equity market. My question to you is, given the large shareholders in Yellowcake, hedge funds, would presumably look to be getting out at NAV or above. My question would be, what sort of offer from utilities or enrichers would you consider if they were to buy out the company as a whole? What, in terms of timing and price for spot uranium?
That's actually an easy question to answer because it won't be my decision. We've got a very distributed share register. We have half our registers in North America. We've got about 30% retail. So if there is a supply shortage and someone wants our inventory, they're going to have to put an offer to the shareholders. We don't have blocking shareholders. So if a utility comes and says, I'll offer a 30% premium to NAV to buy the fuel, then I have to put that offer to shareholders, and shareholders will decide. So, we don't have price points. We don't make trading decisions because the moment I do that, I'm going to trade against my shareholders. So, I think uranium's a commodity. Commodities are cyclical. We think we got in at the bottom of the cycle. We bought our first uranium at $20. It's now $54. In 2007, it hit $137. So we think there's ways to go. But, I think when we do get to the top of the cycle, we probably sit at quite a big discount to NAV, and shareholders will say, well, what are you going to do about it? We can either become a virtual producer and sell it to a utility and factor the receivable, give the cash back to shareholders, or we get taken out. So, but ultimately, it's not my decision; it's a shareholder decision.
Yeah, thanks for that, Andre.
And a question just behind, please. Thank you.
Yes, I have two questions. The first one is regarding higher interest rates that the environment we're in today, and possibly for a while. How is that affecting your business in that your business is in stocking inventory, whereas, what we've seen lately with a lot of commodities is that they, arguably one of the factors that's led to a big retracement in the prices for commodities is that they've been destocking, partly because of higher interest rates. So that's my first question. And the second one is, how different is Yellowcake to the Sprott Physical Uranium Trust?
Let me come to the second question first, because that's the easy one to answer. Strategically, we're the same as the Sprott Trust. They're bigger than us. They own about 60 million pounds of uranium. We've got 20. They're a trust structure. We're a corporate structure. We've got the deal with Kazatomprom, which they don't have, so they have to go and buy in the spot market. But, so that's sort of functionally, we're slightly different, but strategically, we do the same thing. And I don't see myself as a competitor to Sprott or, I'm not going to arm wrestle them for pounds in the spot market. If they buy or we buy, I think it's good for both of us. Your question on interest rates is, firstly, if you look at what's happened, say, take the copper price, it's gone from 410 to 350 in the last month or so. The uranium price has gone from 51 to 54. So it's kind of uncorrelated to what's happening in the broader market. nuclear power is 10% of global electricity across 33 countries. So it's a very distributed demand side. It's not concentrated in China. So again, the supply side's concentrated. But I don't think the interest rates have impacted the uranium side at all. But if you look at the global inventories, China owns about £500 million of inventory. All of that has been procured to fuel their reactor fleet and their future reactor fleet. They don't have much uranium resource domestically, so they own 2 mines in Namibia. They own all the producing mines in Namibia. They buy 50% of Kazakhstan's output, and they buy in the spot market. So that inventory is there to be used, and the same applies across most utilities. So I don't think that there's a lot of trading inventory. In fact, the Sprott Trust, having acquired £40 million in the last year and a half, has really soaked up all the loose spot inventory. The interest rate does have an interesting role to play, or has had historically. So if you go back 5 years, we had an oversupplied spot market. There was too much production. You had interest rates close to zero. So there were traders like Macquarie, Itochu, Traxys would go and buy spot pounds and sell it into utilities as their contracts were rolling off. They didn't want to pay high-priced with producers, so they bought cheaper fuel from these traders in the 2 to 3 year window and kept filling up as those contracts rolled off. And that was doable in a zero or low interest rate environment. Now, there's no spot volume because we were underproducing, and interest rates have got higher. So that source of supply for utilities has hit them at exactly the worst time. So it's had a double whammy impact on the supply side.
Any other questions for Andre, please? Over here, please.
How will the war in Ukraine affect Yellowcake?
It doesn't affect us directly. We can buy from Kazatomprom. That contract runs through to 2027 if, for whatever reason, and I don't believe there will be, if there's secondary sanctions on Kazatomprom or we struggle to get material from them, then we get to look like Sprott. We'll have to buy in the spot market like they do. But I think it's going to drive demand for nuclear and therefore for uranium, and therefore I think it's going to have a push on the uranium price, because the West is going to look for Western sources, and with this energy security and energy transition, people are going to look to use nuclear in a big way. I mean, if you look now around the world, when these surveys come out, wherever you go, it seems that people are more acceptable of nuclear and the role nuclear has to play in a sort of a decarbonized, and certainly in energy security. I mean, look at Japan. They've got 56 reactors, 10 of which are operating. They import all their coal, all their LNG. You can store uranium for decades. It's very energy dense. So, a jelly bean of uranium is the same as a ton of coal. So it's our uranium, which is, if you global production is about 130 million pounds. We own 20 million pounds. Our uranium would fit on half a football field, 3 stories high. So it's easy to store, and that's why I think it has a role to play in the energy security and energy independence scenario.
Thank you. Any other questions for Andre, please? A question over here, please, Pete.
Since you're a stockpiler of Yellowcake, how do you meet your working capital needs?
So when we raise equity, we hold some funds back to pay our working capital. So, if we go out and raise $100 million, we'll hold back $5 million. We typically try and put 95% of the raise into uranium, and we hold back the cash to fund the working capital. We're only 2 employees. We don't have an office. We've outsourced a lot of our activities, trying to keep the structure as skinny as possible. Worst case, we could sell some inventory to fund ourselves, but we really don't want to do that.
Andre, you said it takes about 10 years from exploration to production. Are there any significant undeveloped exploration resources that could be brought on stream?
Yeah, I think, like pretty much all commodity, there is enough uranium in the world. It's just at what price? What price do you need to pay to extract it? So it's there in the ground. At the spot price today of $54 a pound, you can't build a new mine. You probably need $75 a pound. So the uranium's there. 75% of the world's uranium resource sits in Namibia, well, Kazakhstan, Canada, Australia, and Namibia. So the resource is there. It's just at what economic cost do you have to get it out the ground? And who's prepared to pay for that?
The other question I had, the first question I was asking about the scenario for a takeover. The yellow cake, the resource that you own or the trust owns, relative to the global use, how significant is the ownership of the resource versus how much is consumed or used on an annual basis?
So reactors burn about 170 million pounds a year, and if you include reloads, which happen every two to 3 years, it's probably around 185 to 190 million pounds, and we own 20 million pounds. So
okay.
It's fairly significant on an annual basis.
And that's a global consumption.
That's a global consumption.
So you currently own like a tenth of the world's global
but if you look
consumption
at
in 1
global
year.
inventories, they're about 1 billion. Because the fuel cycle from what we own, yellow cake, to fuel rods and fuel bundles, it's 2 years.
Okay.
So the working capital cycle in this industry is 1.5 times or 2 times annual consumption. And then you can never run out of the fuel. If a nuclear reactor runs out of fuel, it's a disaster. It's hundreds of millions of dollars. And the fuel cost is only about 7 to 12% of the operating cost of a reactor. So utilities could pay double the current spot price, and it still wouldn't hurt them. It's much more important to not run out of fuel than it is. If they had to pay $300 a pound for uranium, that would. But $100 a pound, it wouldn't really have a huge difference from where we are today.
Lovely, Andre. Thank you very much indeed.
Thank you.
Thank you.